Hello everyone, welcome back to part 3 of the Basics of Candlestick series. This is the final part, and it's where things get exciting. Today, we're diving deep into how to use candlestick patterns to identify entry points. And as a bonus, we'll uncover how to identify market trends, a must-know skill for every trader. If you missed part 1 and part 2, don't worry. Check the description for the links so you can catch up and stay on track. Alright, let's not waste any time. Let's get started. Alright. We're going to break this down step by step. How to trade candlestick patterns. There are some key points to know before identifying how to trade candlestick patterns. Number 1, the trend. Number 2, the point of value. Number 3, the entry point. So if you want to trade candlestick patterns, you should remember these 3 things: TPE, trend, point of value, and entry point. Before we dive into this methodology, we need to understand each of these concepts. The first thing we're going to dive into is the trend. A chart shows 2 main types of trends, the uptrend and the downtrend. There is also what we call a sideways or ranging trend, often referred to as consolidation. This occurs when the market isn't moving in an uptrend or downtrend, indicating indecision in the market. When the market is in an uptrend, traders are more likely to place buy orders. On the other hand, if the market is in a downtrend, traders are more likely to place sell orders. An uptrend occurs when prices on a chart steadily rise above previous levels, while a downtrend happens when prices consistently decline below earlier levels. Okay, so in this example, we can see that the candlesticks are gradually ascending. In this case, the chart is in an uptrend, moving from lower to higher levels. The chart has formed higher highs and higher lows, a concept we'll explore in another video. Since it's an uptrend, it's likely that we would place a buy order. Now in another example, this is what we call a downtrend. The chart is moving from higher to lower levels. It is consistently declining below previous price levels, which confirms a downtrend. In this scenario, it's most likely that we would place a sell order. This is just the first step in understanding how to place the perfect entry level. Now, the second concept we're going to talk about is the point of value. This includes things like support and resistance, moving averages, trend lines, channels, and more. Okay, the last concept we're going to talk about is the entry point. Candlestick patterns are excellent entry points or trade triggers. Right now, we're going to learn a few powerful candlestick patterns that can serve as perfect entry points for a trade. Once we're done, we'll combine the 3 key concepts to identify high-probability trading setups in the market. Bullish engulfing pattern. The first candlestick pattern we'll learn is the engulfing pattern. This green candle over here is what we call a bullish engulfing pattern. Why is that? Well, it's because the body of the green candle, from the open to the close, completely engulfs the body of the previous bearish candle. The concept behind this is simple. Looking at this candlestick pattern, we can see that sellers were in control at first. The price opened here and closed near the lows. However, on the next candle, buyers opened near the lows and pushed the price up, closing near the highs. This is a sign of strength, showing that buyers have reversed all the selling pressure and even pushed beyond the previous candle's highs. That's why it's called a bullish engulfing pattern, because it engulfs the previous candle and closes above its highs. The next pattern is what we call the bearish engulfing pattern, which is the opposite of the previous one. You can see over here that the first candle is bullish, buyers are in control, the price opens here and closes near the highs. Then on the next candle, sellers open near the highs and push the price lower, closing below the previous candlestick's low. This is called a bearish engulfing pattern, because the bearish candlestick has more momentum than the previous bullish candlestick. So the engulfing pattern is the first pattern we've learned, and it is important for identifying market reversals. Hammer and shooting star candlestick pattern. Now let's take a look at the hammer. The hammer is a bullish reversal pattern because it shows price rejection in the market, specifically the rejection of lower prices. If you look at this example, the price opened here, and at one point, the sellers were in control, pushing the price lower near the lows of this section. However, buyers stepped in, pushed the price higher, and closed near the highs. This is a sign of strength, a rejection of lower prices. And that's what a hammer represents. Now, the shooting star is just the opposite. It shows rejection of higher prices. If you look at this example, the price opened here, buyers took charge and pushed the price up, closing near the highs. However, sellers finally stepped in, pushing the price lower, and it closed near the lows. This indicates rejection of higher prices. Both of these patterns help identify market reversals. Dragonfly and Gravestone Doji. The Dragonfly Doji and Gravestone Doji are quite similar to the hammer and shooting star. The key difference is that a doji represents indecision in the market. However, the Dragonfly and Gravestone Doji also indicate price rejection. If you look at this example, you'll see they closely resemble the hammer and shooting star we discussed earlier. Take a look. This is a hammer and a shooting star. This is a Dragonfly Doji and a Gravestone Doji. The key difference between the hammer shooting star and the Dragonfly Gravestone Doji is that the doji has no body. Instead, it only shows a wick, which can be interpreted as price rejection. This one over here shows rejection of lower prices. This one over here shows rejection of higher prices. Note this. In any given candlestick, if the open and close are at the same level, then it's called a doji. Even though the open and close are at the same level, it doesn't mean that the market is undecided. Here's why. At one point, sellers were in control, pushing the price down, but buyers came in and pushed the price back up, closing at the same level as the open. This shows strength and a rejection of lower prices. On the other hand, in the opposite situation, buyers pushed the price higher and sellers came in and pushed the price lower, closing at the same level as the open. This is a rejection of higher prices. The morning and evening star patterns are somewhat similar to the engulfing pattern, but slightly different. In the first candle, sellers are in control, opening here and closing near the lows. The second candle, which resembles a doji, shows indecision because the open and close are at the same level. When reading this pattern, it indicates that the open and close are the same. At one point, this was the highs of the section, and at another point, it was the lows of the section. Both the highs and lows wicks are the same, so it tells you that there is indecision in the market. In the third candle, the price opened and pushed higher, finally closing near the highs. If you look at the price action, here's the breakdown. First candle, the sellers were in control, pushing the price lower. Second candle, the buyers and sellers were in equilibrium, unable to decide, and they closed at the same level. Third candle, the buyers stepped in, took charge, and closed near the highs. The meaning behind the morning star pattern is that it signals a bullish reversal. And the evening star is just the opposite. In the first candle, the buyers are in control, closing near the highs. The second candle shows indecision. It can't decide whether to go down or go up, so it closes exactly where it opened. In the third candle, bears come in and push the price near the lows, which is what we call the evening star, a bearish reversal pattern. Tweezer bottom and tweezer top. A tweezer bottom is a strong pattern because it shows rejections of lower prices. Twice. First, there is a rejection, and then a second rejection. If you look at the price action, here's what happens. The price opened here, and at one point, the sellers pushed the price all the way lower. Then, the buyers pushed the price higher, closing here. In the next candle, the price opened here, and pushed lower once again, closing near the same level as the previous candle's low. It could have pushed lower than the previous candle's low, but the buyers stepped in, taking the price higher and closing near the highs. The market rejected the price twice, making this a very strong pattern, showing two rejections of lower prices. On the other hand, a tweezer top shows rejections of higher prices twice. I'll leave it to you to figure out how the price action unfolded in this case. Moving on, let's look at a few examples to bring these concepts together. So if we look here, what's the trend in this scenario? To determine the trend using the 200 MA, we can see that the chart is moving from up to down. This is called a downtrend. So the first concept is that the trend is a downtrend. The second concept is, do we have an area of value? Yes, we do. This is the area of value, the resistance. The third concept, do we have an entry trigger? Yes, we do. Over here we have a shooting star showing rejections of higher prices. Now you can see that you're not trading candlestick patterns in isolation, but in the context of the market, meaning you're trading candlestick patterns based on the market structure, based on the trend. This actually increases the probability of your trade working out. Just to clarify, the trades based on the strategy I will show you are all winning trades. But in the real market, you won't have all winning trades. You will probably get a certain amount of winning and losing trades, like a 60% winning rate and a 40% losing rate. The reason I will only share winning trades is that it's easier to illustrate the concept. But in the real world of trading, you won't have a 100% winning rate. Your winning rate will likely be somewhere around 60% or 70% winners. This is not something you should set as your expectation, but it's important to understand this. Okay, this is the first example. Moving on to the second example. Okay, what's the trend? The trend is a downtrend because we can see that the price is moving lower. Number two, where is the area of value? This time, the area of value is the moving average. This is a 50-period moving average, which acts as dynamic resistance. Number three, what is your entry trigger? This time, we have a bearish engulfing pattern. Notice here, the market closed higher, and then the second candle smashed lower, closing near the lows. This is what we call a bearish engulfing pattern. So we've seen the three concepts: the trend, the area of value, and the entry trigger. Now you can go short, placing your stops above the highs, and see if the market continues lower. You can see that we're trading based on what the market is telling us and not just trading in isolation. Example 3. Okay, let's look at this. Ask yourself again, what is the trend? The first concept is the trend. Well, it's an up trend because it has a series of higher highs and higher lows, and we can see that it's ranging from down to up, making it an uptrend. The second concept is the area of value. Do we have an area of value to trade from? Well, it seems like we do, because the price has been respecting the 50 MA here, here, and here. Okay, so number 3. Do we have an entry trigger? Well, it seems like we do. We have a bullish engulfing pattern over here, which is a sign of reversals and rejection of lower prices. The price closes higher and engulfs the first candle. Here as well, the price opens and closes higher above the first one, forming another engulfing pattern. We're going long because it's an uptrend from an area of value. Okay, let's look at the last example. This time around, what is the trend? Well, at a glance, it's an uptrend, ranging from lower prices to higher prices. Number 2, what is the area of value? In this case, we have this trend line support. This time around, it's not a moving average or previous support. It's a trend line, an upward trend line. And if you look closely, we can actually pull out a level here, which we call previous support. So with this, we have two areas of value. One is the upward trend line support, and the other is the previous resistance level. This makes for a strong area of value. For number 3, what do we have? We have a bullish engulfing pattern. So this is your entry trigger. Okay, so we've identified the trend, area of value, and entry trigger. Since the bullish engulfing is a bullish reversal pattern, it's likely we should go long. Okay, let's do a quick recap of what we've learned. So far, we've learned about the TPE, which is the trend, point of value, or area of value. In the video, I made mention of point of value and sometimes area of value, so both of them are the same, all right? And the entry trigger or entry point, both are still the same thing. You look for these 3 things to find high probability trading setups in both bull markets and bear markets. Number 2, we spoke about the various candlestick patterns that you want to pay attention to. The engulfing pattern, the hammer, shooting star, doji, tweezer, tops and bottoms, morning and evening star. So that's our recap for this video. If you want to learn more about trading, just stay tuned to this channel. We'll bring more amazing strategies to use in the Forex market, and check the description for more exciting updates and ways to join us on our daily trading journey. Don't forget to like, subscribe, and share with friends and family. Thank you, and see you soon.